Okay, let's get things started. Thanks everybody for attending this webinar tonight, hosted by FP Markets and presented by Evan Lucas from the Lucas Review. For those of you that don't know, FP Markets is an Australian-owned and ASIC-regulated broker that has been a leading performer in the industry for the past 12 years, receiving over 34 industry awards. Our vision was to create a one-stop destination where traders could access a full suite of trading products, including global markets. We facilitate trading in equities, indices, commodities, futures, Forex, and more recently, Bitcoin via our MetaTrader 4 platform. We look to provide first-class education and market analysis, which in our opinion is the main factor in creating successful traders. This is why we've partnered with Evan Lucas from the Lucas Review, as we believe he offers extremely valuable trading insights and market analysis. We will also be running 2 promotions off the back of this webinar. For our new MT4 customers, you will receive a 20% trading bonus to 2,000 Australian dollars relative to your initial deposit. For new IRIS CFD accounts, we will be offering a no minimum for the first 3 months, so a trade with a market value of $1,000 would only cost you $1 in commission. The link to apply and the terms and conditions can be found in the chat and will be included in a follow-up email from your attendants. You may also email the sales team via email at sales@fpmarkets.com.au. Thanks again for attending, and I'll now introduce you to Evan Lucas, who will be hosting our webinar for tonight.
Thank you, Chris, and I'll take it from there. I hope that everybody can hear from my end. Just a couple of admin things that I've sort of been speaking with Chris about. I definitely want to get to some questions. I'm pretty sure you're going to have a few questions after I finish tonight, considering how I go about doing my trading, my investing, and how I just evaluate things. But if we can hold them off towards the back end, I'm sure you'll have plenty of them, and I want to give you as much time as I can. So I do apologise if I waffle slightly. I do love talking about markets, and that might also be part of it. But as you can see, look, the topic of my thing is looking from above, and the reason I start there is I very much believe that you can give yourself what I call a funnel, which is look from the top, get your macro themes, get your macro thematics, then sort of build that down in through what you need to look at in terms of whether or not you're a stock trader, whether you're a FX trader, whether you're an industry trader, whatever it is, you can get yourself a really good base of understanding from that space and then go into sort of moving to the next level. So that's what the theme of all this will be tonight. I know it's not for everybody, but that's how I do things, and I think it's actually really, really useful to give yourself that really nice base. So on the first thing, look, as always, we do have to go through within all compliance stuff. Again, FP Markets, as it says on the disclaimer in front of you, this is all general in nature, what I talk about. Everything in this, we don't know your personal situation, so please just have a very quick read through of this disclaimer. Be aware that FP Markets are recording this. If you do want to go over it again once we've done the seminar, you can also review it from there. But just be aware, everything that I talk about in this is general in nature. So let's get on with it. And these are the 3 areas that I want to talk to you about tonight, which is the US baseline, the Aussie environment, because I quite like that, the fact that I live and breathe our market with a really big influence from the US. And then I also want to talk about Dr. Copper, because I think that feeds back into the Australian story, it feeds back into the US story, but it is the China link as well. And there's some really interesting things going on in China at the moment, which sometimes I see as a negative. I actually see it as a positive, and I think that also needs to be part of your thinking. So here's my baseline and what we're going to work through sort of on what I really want to talk about tonight. So I want to start with this, and the reason I've got this screen up first is in the current market, we have almost a textbook self-fulfilling problem. And what I mean by that is, if you remember back at your uni days or any of those guys that study finance or economics or what have you, we have a scenario at the moment where we've got almost a deflation issue, but it's not. And what I mean by that, if you have a look at this chart on the right-hand side over here from The Economist, if you have a look, what's really interesting about that is that the top several countries here are all developing countries, all basically those really emerging market sort of places to look at, all the way down to Russia. Britain's an interesting one, considering that its inflation target is actually technically being met. It's why the BOE at the moment is quite an interesting scenario, considering they got really, really negative on the outlook of their economy very quickly off the back of Brexit. And only now they sort of realise that maybe it's not much of an influencer as it was. But then you come down here and you look at us. And the reason I want to highlight this, have a look at Australia, look at the US, the Euro area, Japan, is that at the moment we are in a low inflation environment with highly accommodated monetary policy, despite the fact the US is raising rates, so is the BOE, Bank of Canada is doing as well. It's still record levels on that bottom side. And I'll talk about this later as well. We're having issues with wage inflation. We're having issues also with just growth in general, which is quite interesting because the rest of this slide, this here is the US GDP growth over the last period from 2013 to now. And you can see it's doing okay. I actually think for the US, it's not too bad. But if you look at it on a more longer basis, it's below trend. Then you've got to have a look at this. This here is what the IMF put out around about 2 weeks ago about what they expect 2017 and 2016 to look at from a global perspective. That's really good growth. Now, in that market, in this scenario, when you've got a low inflation environment with good growth, you want exposure to growth. And that's the dilemma that has happened from an Australian perspective, and I'll come to that when we look at the ASX, is that we are a value market and the US is a growth market. So if you then also expand a little bit further out on that and have a look even further down that list, this is why developing markets are really interesting, because you can clearly see that although China is slowing down, there are other markets like India that you're actually now starting to see movements in that as well. And that sort of gives me that baseline also to talk to you about copper and why copper is such an indicator of growth. And again, why I at the moment believe from a macro thematic idea, you still want to be exposed to growth, despite the fact some people might point to the idea that things are slightly expensive in that space. It is clearly the place to be. Momentum is still behind it. And what's even more interesting, if you look at emerging markets, you look at America, even to some extent, you look into the emerging parts of Europe, they're the ones that are still justifying with earnings now backing that up as well. So whether you're an indices guy or whether you're an FX guy, that all filters into it. So, whoops, apologies. Let's look at the US baseline, because out of all of this, it is the most important thing. And still, as you can see with Benjamin Franklin on that page, the US dollar is absolutely key to everything, and it provides the baseline for any form of your trading, whether that's FX, indices, stocks, doesn't matter. What goes on in that currency really does matter to how you actually look at your investments going forward. And that's why, as I said, this is where that growth v value trade really comes to the fore. This is a comparison of what I believe is probably one of the most clear value markets on the planet, which is us. We have a yield at around about 4.2.5%, 4.3% versus somewhere like the US, which only has around about 2%. If you look at our nearest competitor on a yield basis, at the start of the year, it was the Hang Seng. The Hang Seng was at 4.3%. The difference is that the Hang Seng is up almost 20% this year, whereas we, as you can see on that chart, are only up 5.6%. You can also see here that if you look at the NASDAQ, which is probably one of the best ways to look at growth, it's up 27 over the same period. And then you've got 16% for the S&P 500. And again, they're more leveraged towards that growth idea. And this is where the US markets come to their fore. So that brings me to what's going on their market. The Fed is clearly part of this. And where is the Fed at in terms of what they're going? We know that they are very happy with how their employment market is going. In the last sort of week and a half, we've actually seen that they're starting to get their inflation to their target mandate of 2%. They also clearly believe that economic growth is moving through wealth as well. They have a problem like we do, which is the only caveat to this, which is that wage growth isn't moving. But for those of you that are slightly unsure about what this sort of illustrates, this is the Fed dot plots. The Fed is probably the best central bank on the planet at actually telling you what's going on. So all those yellow dots are the Fed members and where they expect interest rates in the US, so the Fed funds rate, to be at certain periods of time. The green line is the line of best fit. If you have a look also on there, the line that is in grey and the line that is in purple is the overnight interbank market, which is purple, which is the futures market, which is obviously the swaps market in FX land. And then you've got the Fed futures, which is in grey, which is also a market product as well. You can see the market does not believe the Fed is going to raise rates anywhere near the pace that itself is forecasting into it. What you can tell from this chart, though, is that by the end of this year, there will be another rate rise, which means in around about 2 weeks' time, give or take, I think it's the 16th of December, is when you'll see the next movement. The interesting thing about 2018 and why the market is quite sort of interesting with it is that you've now got a scenario where you've got a new Fed chair coming in Jerome Powell. You've got a scenario where things are possibly going to move towards a more slower process even with the gradual under his sort of tenure. Plus, there are a few signs that maybe with inflation the way it is, it may give him a little bit of a chance. The reason you have to look at this is that this puts you into a scenario where you can start really giving yourself a baseline on the US dollar. And that brings me to what the market is thinking about that as well. So if you have a look here, I really love this chart. This came out by Morgan Stanley. This is a really interesting scenario now of implied rate market movements. There is clearly one moving up here, and they're starting to actually believe that they could happen. The interesting thing about this chart is that it doesn't take into effect Jerome Powell being put up by President Trump about a week and a half ago. And if I had a little bit of extender, it's actually done ever so slightly. It's come down here, not much. But in saying that, that's also the next scenario and the next part of your thinking, from my perspective anyway, about how you look at the US dollar. Because this is what's really interesting about everything we just talked about. The scenario you have, you've got rate hikes coming in, you've got a growing economy, you've got increasing wealth, you're starting to see slight inflation. It's not what you'd call rapid at 2%, but in saying that, you're starting to actually see it. You would therefore expect this chart to be moving much, much further this way. And this year, what's been really interesting about Dixie, which is the dollar basket, is that it just hasn't done it. And only basically towards the back end of September, where there has been some movements, particularly in Europe, that this has started to move. You've also got things like dollar yen that's also started to pick up. But this is really interesting that over the year, we've actually lost bids in the US dollar. And it's certainly not what you would expect to be the scenario. It's certainly not what you would expect with that coming into it. So the question for you is whether or not you see this now returning towards back to where probably is more likely sort of semi-fair value, which from my eyes is about 98. And the reason I say that is that you still have fairly, highly accommodative policies in Europe. There's no way Japan's going to move anytime soon. The only sort of major currency pair is cable, with the BOE starting to move on the pound. But in saying that, sterling's still substantially weaker than where it was around Brexit, when it was 150, and we're now sitting about 136, and I'll come to that. So where does the US dollar go from here? And I think that needs to be a real key sort of baseline to where you're at, because under theory, it should go higher. But what I will now show you is that there are just signs the market just cannot get excited about it, which again is slightly interesting from a top-down perspective. So just remember that chart, because when you come to this one and have a look at the euro dollar, it's basically inverted. And you can see very clearly that if you almost track back from this one to this one, you can see it's pretty much the reverse. And it has been a really interesting year for the euro. The euro strength has been probably slightly justified. You are starting to see the periphery, so these are the nations outside of the core, places like France, places like Germany, also to some extent. You can sort of throw in Italy. I more think of things like the Netherlands, etc. They're also part of that core group, whereas the periphery, places like Spain, places like Portugal, Greece, I'm sure you're all aware of, also places like Ireland, have had issues, but their bond markets are starting to actually show signs of strength. You're actually starting to see them returning to some sort of normality. They're still sitting at fairly horrible levels, but all of that has helped the euro. You've also seen that actually you're seeing GDP growth happening in the European Union, which is something that has taken a very long time and a lot of work from the European Central Bank to get there. So this movement is probably justified over the year. And again, it's partly to do with the fact that the US dollar has lost its bid, but also the fact that Europe has got slightly better. What has been interesting is what's going on in here. And that's why I call this the battle for the Atlantic, because it's starting to get slightly painful for the Europeans, particularly places that are high-end manufacturing and high-end manufacturing. Think Germany, think France, places like here that do really rely on, an exchange rate that is at a reasonable multiple to one of their biggest markets, if not their biggest, depending on who you look at, in the US. And you've just started to see some breakdowns in here that I think are really, really interesting. So before I go any further, some people are actually putting this movement here down to what happened with the German election. And the fact that at the moment that we've got a scenario where maybe, just maybe, the Germans go back to the polls. So that's why, just in here, I just wanted to highlight what's going on. So this here was the German election, and you can see this gap here was quite dramatic. It did actually put a bit of weakness into the euro, but in saying that, it's sort of then hovered out, and you can see that it's sort of maintained a bit of a level after resetting to the fact that Merkel was going to have a minority government. She was going to have to work slightly harder. And what wasn't expected to see was 94 candidates for the differing opinion for Germany coming in there as well. But what I really want to talk about is what's happened basically at the back end of October and November, because you can clearly see at the moment, we're going through a really interesting range. And those of you out there that do like a little bit of vol, do like a little bit of movement, and do like to sort of get what I like, which is some top-down economic thematics to come into it, you're getting that at the moment. And I think that's sort of what I want to talk about. So bringing into it, this scenario right here. This is what's happened over that period that I just talked about. So basically, if you have a look at from the 26th of October to today, because all of those really sharp movements are to do with what's been going on in economic releases, and therefore from my bread and butter, the actual going on for the macro thematics. The blue on the left-hand side, the one that happened on about the 27th, that is the ECB. And the ECB clearly does not like the euro, pretty much looking or wanting to get above 120. It starts making things much harder. GDP growth starts to get a headwind as you start to get an FX headwind. They are clearly also alluding to the fact that, yes, things are getting better in Europe, but in saying that, it is very, very gradual. And very clearly what he pointed out in that chart there, and this is Mario Draghi, is that they are unlikely to be moving away from their highly accommodative monetary policy as fast as what the market was saying, or realistically anytime soon. So what they are doing, they're changing their balance sheet. For those of you that are aware of it, they have these things called litro loans, where they are actually allowing, basically selling out into the market, but it was already soaked up, and they're actually unwinding that and closing their balance sheet down, similar to how the Fed did with their QE program. It wasn't bid up as well as their QE program over in the US, but they have got interest rates, their three bands, that are incredibly low. You've got things like their lending rate, their deposit rate, that are either at neutral, in the deposit rate scenario actually negative. All that, therefore, is going to stay. So that's what happened there, and you can see why the euro fell away. There was a repricing over sort of, particularly over the last sort of week and a half. But then we start coming to what is really core and why we're talking about the US dollar baseline. Because then you got what happened in here, which is talk from the Fed and also US inflation. So you can see on the 14th, sorry, around the 15th of November, you got the Fed in the FOMC coming out and saying very clearly that gradual rates are being evaluated consistently. We still believe that we need to look at how things are moving from an inflation basis, also whether or not wage growth is coming into it, despite the fact that our first mandate's being sort of reached. And that sort of put a rocket under the euro, and all that US dollar bids just dropped out like a stone. If you guys trade Aussie, you would have seen it as well. It affected everything, but the euro US is at the moment the one that I really like to look at, because it just reacts to everything around that idea. It was also at the same time as as the European Union released their GDP figures. So you had a double whammy. You had the Fed, and then also the euro that actually showed that their growth is now sitting at around about 1.4%. That is realistically anemic, but in a world where growth has been pretty much sitting in the low 0.8 as high as 1% year on year, it was seen as a bright spot, and it was an upgrade from the previous quarter as well. You then also got an interesting story where you got euro inflation that was also sort of moving on. Then to reverse that, you got US inflation coming out, and that's what happened here. So this is clearly interesting from my perspective, is that at around 118 and a half, as you can see from that figure, is where we start to sort of get this really interesting inflection point. I highlighted deliberately in red because I don't want you to get confused with the fact that I put in blue the economic stuff. This here was what happened a weekend ago on the weekend, around the fact that Germans might go back to the election. And you can see how much the geopolitical pressure put into the currency, but it's clearly not as influential at the moment as the economic macro material. And that's what's clearly interesting about this. Then this happened here, and the reason I highlight this is this again gets back to the Fed and why the US dollar at the moment is just moving everything on a more negative basis for it and a positive basis for every other currency, because people are just trying to pick holes in the idea of rate rises in the US. And again, this is the FOMC minutes that came out, and that showed you. So if I move on and have a look at the pound, it's a similar thing in terms of what's going on in cable. So on the far left, way over here, this is Brexit. For those of you that experienced it on the day, geez, it was an amazing experience to be in the office, to actually sit there and watch it, watch cable fall from 150 down to as low as 122. I saw it at one point, although this chart doesn't show you that. It was just the gapping was huge, the spreads just exploded and blah, blah, blah. It then got another leg lower, and if you can remember, sort of in October last year, there was an interesting sort of fat finger trade, and that's what you can see on this part here. But in the main, if you actually draw through it, it's pretty flat. It's actually sort of reverberated to where the market initially revalued what a Brexit would mean for the UK, and it's come back to that. What's really interesting about it, again, is that you've now got a central bank sort of moving towards the idea that rate rises are justified. So we've seen one. You may actually see one or two in 2018, and cable at the moment is really showing you that it's to the upside. Sterling has clearly been relatively well bid, and the US dollar is just slowly but surely grinding out and losing bids across the board. So with that in mind, and keeping a US dollar from there, I want to bring to what my bread and butter is, which is the Aussie environment. So with that, I'll bring on to that. Just excuse me for 1 second. The Aussie environment at the moment, from my perspective, is in an interesting conundrum. And the reason I say that is that we have been somewhat, and I say that deliberately, somewhat isolated to what happened over the last 7 to 8 years. Putting your political views to one side, the mining boom has certainly been an important help. China has been a huge help. We've also had a scenario where we didn't go as hard on our monetary policy as others. We've had a scenario where, although there's been slack in the economy, we've had fairly reasonable growth through that period, despite the fact that you've had pressures going elsewhere. What is interesting right now, though, is that we are just sort of slowly but surely getting to what the rest of the developed world is experiencing, which is issues and breakdowns in traditional sort of thought on a macro basis. So that's why I want to show you this, because domestically, things are really, really interesting. So for those of you that know what the statement of monetary policy is, this is the table that realistically, from our traders' point of view, from an investor's point of view, all that matters. This is the forecast and the outlook for the RBA over a 2-year period. It reiterates every quarter. And the interesting thing about this one is that everything was basically downgraded by about 25 pips, so 25 basis points. But what you really need to look at is that underlying inflation figure. If you know about how the RBA works, the RBA's #1 mandate is to basically maintain inflation between 2 and 3% on an underlying core basis. So that strips out things like food, fuel, etc., things that actually have quite large fluctuations on price. For the first time in a very long time, they are actually estimating over a 2-year period that they won't get into that band. And this is why, at the moment, structurally, the Aussie is under real pressure, and I'll come to that. It also suggests that we too are about to enter into this deflation issue. And for those of you that may have seen Philip Lowe's speech this week, I think that was one of the more telling stories I've seen in a while, which I've never heard him be so, not even, the word's not panicked, but he's certainly disheartened by what he's seeing at the moment with regards to the outlook for where he thought the economy was going to be and where it clearly is. And that therefore means that despite the fact they've got pretty optimistic GDP figures in here, and I think that needs to be really highlighted, this year at 3.5% is going to be pretty good. That means that you're going to have to see net exports doing quite a lot of lifting. It also means public spending is going to have to do quite a lot of lifting, easing off towards the back end of the year. It's going to be hard to see that with this going in. And then the next part of it is this. Wage price index until about a week ago was not that important if you are looking at it from a trading perspective. It was always seen as something to be a bolt-on to your thought. It was always seen as a way to just sort of give you a gauge to possible things like consumption, possible things like inflation. But this chart was put out as basically the idea that this is now our biggest headwind. And it is, and I can't even deny that. It is clearly going to be our biggest headwind. So just having a look at this, if we didn't have public sector growth of 2.4%, you'd basically see that the private sector is growing at only 1.9, which realistically means around about 65% of our population is getting just over CPI in terms of real gross wage growth. And that means that we're only getting 0.1 of 1%, considering that underlying and core inflation is sitting at 1.8. We're only getting 0.1 of 1% wage growth. Now, think about that from the point of view of GDP expectations. About 40 to 42% of Australia's GDP comes from consumption. And this is what you're probably hearing a lot in the media. It's also probably what you're seeing in your trading, is that there is now this big fear that consumption could fall off a cliff. Because the other thing that's come out this year and a couple of times is you actually have a look now at what they call basics, which are things like living, housing, things like also like education, health, and food. Those 5 factors are now making up roughly about 59 to 60% of the weekly wage in that alone. So discretionary spend, overconsumption, sorry, not overconsumption, but additional consumption is being squished to one side. And more that could happen if you continue to see this chart trend here. So with that in mind, it brings me to this chart, and I love this chart. This comes out of ANZ. They do this all the time. It's a really, really interesting chart about Aussie dollar, US dollar. I've already told you why the US dollar is quite interesting and is your baseline. Unfortunately, no matter how hard we try, the US dollar always takes over. You've got to have that in the back of your head. But the Aussie at the moment is trading in such an interesting structural pattern that you can play this out. So if you have a look at what's going on in this chart, that long-term relative purchasing price parity point is where the Aussie probably needs to be about roughly sitting. You've got one standard deviation either side. And you can see that when this chart came out, we're just starting to see that in 2017, we're moving back to where we probably should be, which is about fair value in here, which if you look at that chart, it's probably sitting about 73, 74 US cents, which gives you a really good baseline to what we've just talked about. So again, want to highlight the numbers that I've got on here in terms of what's going on. So if we go back to the far left of that chart, we talked about inflation, and that inflation read that came out on the 26th of October was the first time I've actually seen a proper structural breakdown from the Aussie dollar side of the equation. Normally the US dollar has been driving this. We got even as high as 81 cents sort of about July this year. But that there, I think, is a real key point to what's going on, is that clearly inflation is now a big concern for us. The ability for the RBA to raise rates is being constrained further and further and further. And that's what that chart showed you, is that they're inside that 2 to 3% band isn't going to happen in the next year, 2 years. The possibility of a rate hike, despite the fact that's what Philip Lowe says is going to happen as the next movement, is so constrained. If you look at the interbank market, so the swaps market again, the probability of a rate rise happening by November next year, so 12 months from today, is now sitting at around about 62%. If you had to ask me that same question about 5 to 6 weeks ago, it was sitting at 100. So that shows you how much of an impactor the inflation rate had. The second blue circle is that wage price index and how much of an impact that actually had when that came out. And clearly you can see that those two go hand in hand. If you're not getting wage price growth, you're not getting consumption, therefore you're unable to see goods and services increasing in price. It feeds back into the inflation conundrum. It also feeds back into GDP as well. Now the reason I've got those two red lines highlighted, those red circles on the right hand side highlighted, it's very interesting, again, the ability for the US dollar bid to fall off quickly. So I've highlighted the one on the first one on the second from the right. That one there was Lowe's speech that happened this week. So despite the fact, as I said, that he slightly sounded quite disheartened by what was going on in the Australian economy, despite the fact that he was saying that, you know, the ability and the current environment to raise rates is very much removed, he did say that the next rate movement is most likely to be to the upside. Market picked it up immediately, US dollar got shared fast, and that's what happened. You then also had the next scenario that's going on inside here as well, is that again, some of the US data that's happened over the last sort of 24 to 48 hours has again just given that reason for that baseline, that US dollar to drop off. And so the question I'm asking myself at the moment with my trading from that macro thematic idea is that I did and expected to see a structural movement from around about sort of 79 to 75.5. What now pushes us through that figure? What pushes us to sort of not only get through 79.5, 74, so 75.4, what gets us to what realistically should be fair value, judging by what ANZ are telling you in this chart, which is probably about 74. And that's the interesting thing. I just think right now, you may actually see just a bit of a sideways trade. What may also be interesting is what's coming up on, as I said, with the Fed in December on that 16th number of whether or not they start to talk about not just gradual, but almost glacial movements inside that space, that you may see the dollar pick up. But what's been told in this chart and the movements that happen to those economic releases, I think need to be really based to what you now think about. The Aussie should be and is moving towards a structural difference It is no longer sort of trading in a band, and it should therefore head and be fair value around about 74 cents. And that's clearly what I'm talking about here. The interesting thing about what I've got on this chart and why I've done it as well is that you can see what happened when Trump came in on the left-hand side, and then also what happened when the Fed, despite them raising rates in December last year, happened. The US dollar fell like stone. And that's what may come into fruition this time around, and why I just wanted to highlight what happened last year around that. So put the Trump story to one side. The market's reaction to that was slightly unknown. The reason it did fall away is that his fiscal policy is very, very accommodative, and that's why the US dollar fell. But in saying that, the reaction to the Fed as well was also quite an interesting reaction. So plays into some interesting sort of scenarios there. Right, which brings me to the next part, and it brings me to, let's be honest, the market we should all know, considering it is our local market. We are what I call a bell bar. We have a very, very uneven and a not very diversified market. If you compare us to something like the DAX is probably the perfect diversified market on the planet. There's 30 stocks, 30 best stocks in Germany. They are ranging between sort of 14 to as much as sort of 18% on their upper side sectors, all the way down to as low as 7%. But they are almost perfect across their whole space. There's manufacturing, there's financial services, there's medical, there's materials, there's manufacturing. It's a beautiful market, whereas we, on the other hand, as you can see, are 37.2% made up by financials and 17% made up by materials. Now, what I would also point out to that, and what this year has been quite interesting about and why we've been a laggard, is that value trade. If you looked at that sort of breakdown at the start of the year, you would have seen that financials made up roughly around about 42 to 43%. If you threw in the REITs as well, it moved up to 48. This year has been a really good year for materials. At the start of the year, they were sitting at 13% breakdown of the ASX. Now, as you can see, they're sitting at 17. But if you look through that and look down that level, the gap between materials, real estate, even consumer staples is substantial. And you can see that basically you need to have, as I said, a bell bar. You've got materials on one side, your banks realistically on the other side, and everything else fits in the middle. And if you have that as your thinking, it sort of gives you a really good idea about how you can sort of look at the ASX and possibly trade it. Because again, from my perspective, and what we started to talk around about, low inflation environment, you want exposure to growth, 2018 could again be the year that has been the materials this year. So with that talking in mind, everybody would have been fairly arranged to what happened in the midway through this year. The range in the ASX between basically the end of sort of May, mid-May, all the way through to the breakout that we finally got in October was one of the hardest trading periods I've had in a long time. And the justification of it was interesting. We had a really, really anemic FY17 numbers, which is quite surprising, considering that leading into FY17, so the August reporting season, there wasn't a huge amount of confession season. Earnings had been looking like they were growing quite nicely. If you have a look at the GDP figures that were coming out, they were good. If you have a look at the capital expenditure, so future expectations of firms actually spending, all of that was looking quite rosy, and it didn't deliver. And it was really, really annoying. And then not only that, they give you outlook statements was zero. We got nothing in terms of any form of growth or any form of movement. What has been interesting with that October uptick and finally punching through and getting on with it is that you've actually finally had a bigger run up in the banks. Maybe the pressure on them wasn't as hard as was forecasted, but not only that, the story around growth started to really justify it. And that was what was quite interesting. So this is the financials. So that includes the banks, things like Macquarie, but also includes the diversifieds. And you can see very clearly that the range that the ASX was stuck in is probably partly down to this. And they haven't recovered anywhere near as much as what you would hope. They're certainly up, and they've certainly moved through that period. But again, in a growth market, they're value stocks. Yes, they're giving you a dividend yield for those of you that do it on a direct investment perspective, but we're talking about trading here. We're talking about movement, and value is hard to find. Not only that, talking and getting back to looking at sort of more granular level, if you get into the banks themselves and all the stuff we just talked about with the RBA, is that if you've got a tightening of that wage price index, it's not rocket science. It's, you get told in the media every day of the week that the housing prices are starting to look frothy, purely due to the fact that our debt to income ratio is starting to really move on to it. You've got a scenario also where if you're not seeing an increase in sort of the returns that you're getting from your property, why would you start looking at it as well? You then have a scenario where at the moment financials are trying to actually slim down. because organic growth they had from 2013 to now is also slowing. So it's not hard to make an argument about why the banks are probably a little bit dull. They're still going to do quite well. They're still going to return, probably growth on their net present line of around about sort of 2, maybe as much as 7%, depending on which ones you look at. But that then compares to these guys and materials, and you can see very clearly that if materials were probably what they were in 2011, the ASX would probably be catching up to the S&P. And you can see very clearly how strong that's been. So interesting that this drop off here was actually down to sort of the fact that you saw iron ore really come off, and that should have. You saw the really big ramp up that happened in Chinese stockpiling. You saw the really big ramp up in Chinese steel. You've seen a really, really interesting ramp up in their expenditure for infrastructure. All of that has justified that. All of that shows you that if they're going to continue to be what they want to be in what they call their 2010 to 20 decade, they have to keep growing at the current rate for the next 3 years. So that justifies this chart. That's why I quite like growth. I quite like materials for this reason. And I've sort of been happy to get in on the dips on the back of the idea that China is justified. And that therefore means if you look at it from a year perspective and what's happened over the year, this shows you that although we've gone through a year like it has been, financial services actually haven't changed. In fact, at the end of today, they were down 0.1 of 1% for the year, whereas you have a look at what's going on in the materials index, it's up 13.5%. And that's, again, what's been really hard to sort of push to people is that people are still quite concerned about what's gone on in that space. The fact that you did have such a big cyclical downside in the materials over the last 3 to 4 years, since the 2013 peak, that you sort of may have missed the idea that materials are probably where you want to be. And next year is still looking like that could be the case with growth being that space. Yes, China is slowing down, but it's still growing at a fairly reasonable clip. And if you compare 2018 forecast to what they were doing in 2010, in terms of physical value to value, it's roughly just a little bit more, despite the fact that they're growing at around about 4.5% less. It's still a place to be, and it's still going to grow at rapid rates despite what's been talked about. And that's why I still want to be there. And that brings me back to, and I'm just going to quickly move back to that. Therefore means that are we going to see an Aussie landscape that can see an ASX pushing back towards even as high as 6,100 points? Possibly. It's just a question, and it is a question about whether or not value stocks continue to hamper and cause trading like this, or whether or not they can actually sort of just catch the coattails of growth stocks next year and help us push towards. I don't expect us to, unfortunately, catch up to the US. We're just not that kind of growth market. I definitely don't expect us to catch emerging markets, but there's no reason we can't grab onto the coattails. There's no reason that growth can start to really filter in and move through, because have a look at things like capital goods as well. All of that is there, and certainly a space that I really would think that will be quite interesting going forward. So let's move to Dr. Copper. Again, just excuse me. China at the moment is a very, very interesting place to have a look at. I know lots of people will point to the geopolitical scenario that's going on in Beijing, the fact that you've now got Xi Jinping moving towards the idea very close to what Deng was, if you follow Chinese politics, or even going back, some people compared him to Mao. He's not that. But it's clear that China is moving in a different direction to probably what you would have seen under Hu Jintao, or even with Premier Li Keqiang, who's still in power, and his sort of policies around fiscal stability, etc., etc. Just again, trying to just look at it from a more simplistic idea. And what I mean by that is that is China going to continue to stimulate itself? Is China going to continue to look at moving in a direction that therefore drives sort of things like infrastructure spending? I think you've got to probably make the conclusion that yes. If you have a look at what happened when industrial production in China got to a 25-year low, there was a slight panic, and they did very clearly move on that. What I'd also highlight is getting back to the start of the presentation, showing you that chart from the IMF, is that you actually saw that there's been growth in Europe, there's been growth in places like the US, there's also GDP growth happening in Japan, and the effect on China, that perspective, is that they are the 3 largest markets that they actually trade to. And Chinese exports are starting to show signs on the up. And that's why copper at the moment is probably one of the best gauges of where Chinese growth stories are heading towards. And that's why I really, really love this chart from Bloomberg. For those of you that do look at copper, and the reason copper is such is because it's involved in everything with regards to things like manufacturing. The other thing about copper, and it's sort of slightly off topic, and I'll say it, is that copper is also needed in the future of things like batteries. And it's clear that India are part of that, and that's a story from another day. But I really want to show you what's going on here, because you can see from the back end of 2016 that the Chinese demand for copper has actually really started to move on, and move on quite nicely. You're also getting a kick from the US as well. The US housing starts have started to grow. If you listen to somebody like James Hardy, which I think is actually better to listen to them rather than some of the actual more macro thematic ideas, because they're living and breathing it, they're surprised and pleasantly surprised by how US home growth is going, new starts going, the demand for products inside the home. They were quite surprised by that, and that all feeds into that copper story. The copper story is also being met by the other side, supply and demand. It's a clear part of this, and not only can you take out what I'm talking about with copper, but you can see that aluminium, nickel, zinc, lead, and tin are all in the same scenario. We at the moment are at a level where we have seen pre-crisis stockpiling. So the sides of it is one, demand is on the up, supply is on the downside, which is a really interesting scenario. And again, why there are a lot of very bullish people on bulk commodities, and copper is one of them, particularly that they're quite excited about, because if growth is coming, like the market is expecting, like the IMF is telling you, like most investment banks are telling you, copper is the one space that will give you a really interesting gauge to it. And that is because copper is almost a gauge of growth. And as I just outlined, the reason for it, from a macro upside, map down perspective, it just involves with everything with regards to construction, work done, growth in general. And that's why this is very interesting from my perspective as well, is that if you are seeing that much drawdown going on tonnage, you're clearly going to have a scenario where there will be firms to pick this up. And if you listen to Rio Tinto, they are clearly moving into copper as sort of the future. Even BHP are talking about it. Listen to those guys overseas, listen to Glencore, and you can hear what they're talking about. Even the US heavyweights in their copper space are looking in that idea as well, that they believe copper over the next 18 to 24 months is a really, really interesting sphere. So then you got to look at it from a high grade perspective. And again, this has also been a market that I really sort of liked looking at, and you can see very clearly that uptick in demand that happened as we really started to move into that Chinese demand story. You fell off as they led into their People's Natural Congress. Almost everything stopped, which was really interesting around that space. Iron ore fell off a cliff, copper fell off a cliff. But even with that in mind, if you listen to what's happened in the futures markets over the last week, coking coal limited up twice, yesterday and today. If you have a look at copper, it moved up in Shanghai off the back of it. If you have a look at Chinese steel prices and steel demand, it's through the roof. Iron ore hasn't caught up to it, and nor has this. And copper is the way you can probably get exposure to that. And that clearly suggests that China next year are moving towards an idea that they do want to be involved with a growth story. And again, it gets back to my whole thesis on this, is that in a low inflation environment, I want to be exposed to growth. So with that, I know that's a huge amount to really sort of digest. I know I've been rambling on for about 45, 50 minutes, and I do apologize for that. If you are out there, please start sending questions in, because I'm really happy to start talking about this. But as I said, this is how I look at trading. This is how I look at mathematics, and these are the sort of the spaces that I see and what I see inside of it that actually make me excited for trading and for investing. And there's a combination of, you know, a bit of everything in what I've looked at there today, and I understand that. And you can see that I am slightly negative on the Aussie, and I think that's sort of justified. I am slightly more positive on the ASX if we can get ourselves into the growth scenario rather than probably being a value scenario. I very much think that the US markets are still going to be quite strong, because despite the fact that they've got raising rates from what the Fed is telling you, the US dollar just isn't really pushing further higher, and that therefore is just giving a little bit more credence to places like what you're looking at from an equity perspective, bottom up. If you do that kind of thing, you can see all of that idea that, you know, the fact that you are getting a scenario in the US where growth on an EPS level is sitting about 7% for their big ones, that's a huge story to really look at from a perspective going forward. I've got a question here coming out for, can I discuss Euro Aussie? Okay, Euro Aussie is a really interesting one. And again, the reason I find it a little bit tough, and thanks to the question who sent that in, I think it's from Laura. The reason I find it quite tough is because it's not as easy from my perspective to get the sort of the central bank sort of lineups as much I would normally look at. And what I mean by that is that the volumes through it is a little bit lower. You've got a scenario also where the two central banks are probably slightly negative, and I don't follow it for that reason. Sorry, Laura, but you can see there are some interesting sort of inflection points coming into it. Again, I am negative on the Aussie dollar slightly in general, and if you have a look, particularly over the last week, despite the fact that the US lost bids, the Aussie actually lost more. And I think that might be a way to answer that question, is that at the moment the Aussie is clearly resetting, and I think that's what's been going on over the last couple of weeks. I hope that answers your question, Laura. Yeah, I've got another good question, and that is a really good one from Gareth, which is, how do you cope with the volatility in Dr. Copper? Very good question. Again, the way I look at it is that if I can't either have a stop loss inside Dr. Copper, or if I can't sort of see the gapping that happens inside of it, the way I would probably look at getting exposure to copper is looking even granular and going into almost a pure play on a market. Now, there's some really good ones in Canada, some really good ones here. I mean, I'm not a massive fan of, and I'm certainly not advocating this, I'm not a massive fan of something like Oz Minerals. But in saying that, if you have a look at them, they are, you know, fairly closely tied to what happens in the copper price. So that might be a way of giving yourself a copper flavour. You can also have a look. There are some indices trades out there. There's also some ETFs out there that have got fairly good copper sort of breakdowns. That's probably another way to look at it. I mean, again, if you want to look even further and still stay at the granular level, your BHPs and your Rios in this world are very good copper plays. I mean, if you have a look at BHP, it still has the largest copper sort of exposure you can probably get in the Australian market. Rio is probably touching close to it as well with Karankot and what's going on with Oratogo, and they may overtake them with what goes on in Mongolia, but that might be a way of doing it. And having a look at it in terms of that idea. Next question also, if copper's the flavour, what's the effects on places like gold, silver and platinum? Okay, gold at the moment I think is clearly telling you also similar theories to what I sort of had to you before around a low inflation, high growth environment, in that gold is sidetracking. So when you have inflation moving in the right direction, gold should do what it does. It's a store of value. At least that's theory. It's not like that anymore. I completely understand that. But gold, for that reason, from my perspective, is just not as exciting as it probably would have been a couple of years ago. And I'll also put my hand up and be very honest, I don't like trading gold, and the reason for it is that there are so many different factors that come into it. What's going on in the US dollar, what's going on in US inflation, whether or not demand out of India and China is moving, all that sort of clouds my ability to sort of get variables down. But again, growth, and if you want to go through commodities, I'd probably look at the bulks rather than looking at gold. Yeah, great question. Coming in from Peter, and it's just really short, sharp and shiny, which is, any views on oil? I've got plenty of views on oil. I've done a presentation, I'm doing a couple of presentations for FP Markets weekly around it, and I think at the moment oil's a really, really interesting sort of scenario. And the reason I say that is that Goldman Sachs came out with a beautiful report about 2 years ago that showed that non-OPEC nations will start turning their oil rigs on at about 53 to as high as 57 US a barrel. And the reason for that is that they're soaking up value. And that therefore suggests that there's actually a really decent ceiling at around about sort of 58 to 60 US dollars a barrel in the price of WTI. And the reason for that is that although OPEC is working its butt off to try and push the price up by freezing, realistically trying to sort of impact supply, non-OPEC will just come in and pick it up. And you've seen that particularly since past that massive fall away in 2015, it's hit this level 3 times, it's jumped through it and then falls away again. And you can already see, look at Baker Hughes, have a look at the EIA data, it's starting to really ramp up. Supply is, so there was a bit of a drop down in stockpiling, but last weekend there was a massive surprise. They actually had a $4.2 million difference between consensus, which was to see a drawdown, and actually what happened, which was about 2.1 million barrels stockpiled. And it probably will happen again. And that's why oil at the moment is a really, really interesting market, because it's got great geopolitical materials, and I can talk about this at the cows come home. OPEC will work their butts off. Next week's Vienna convention will be there. There'll be a lot of bluster. There'll be a lot of gapping in the price. Be aware of that, because you'll hear rumours coming out of Saudi Arabia, whether or not Iran and Iraq get involved. All that's all well and good. I think you've got to go back to that band and that base case scenario coming out of Goldman's, which is non-OPEC nations will pick that up. The US is the best way to get it, but it's not just the US. Canada does it. Norway does it. Places like Kazakhstan does it. And despite the fact that the Russians are currently sitting and talking with OPEC, they are always, and have been since 1990, the first ones to break any forms of agreement. And they're not technically part of OPEC either. So that's my macro view on oil. It's a real interesting trade. And it will be interesting to see whether or not it does break through to the upside. Because the other side of it, if you have a look at demand at the moment, just isn't materializing either. Okay. I've got the question I've been waiting for. Does Bitcoin have a future? I've been waiting for somebody to ask me that question. Okay, I'm not the best person to talk about this. FP Markets, as you saw at the start, Chris talked about this. They are offering deals around Bitcoin. Does it have a future? The technology does. Blockchain is clearly going to be very influential in the future. And what I mean by that is that the ability to actually make sure a system knows where things are moving is there. Whether or not it's Bitcoin is a different story. The catch that I personally have with Bitcoin, and this is the question I ask everybody, is what do you do with it? What exactly do you do with Bitcoin? It doesn't have a yield. It's not backed by an economy. It's not, it's not realistically an ability to actually go online and shop. I know that's what originally the whole idea is, but what do you do with it? So you are buying it for pure speculation. Is that what it is? Are you buying it because you believe it is the future, and therefore, you're happy to see it go up and up and up? But again, the Warren Buffett quote is the one you've got to look at from the point of view is that, would I rather have exposure to every farming sort of provider in the US, or his quote at the time was gold, or would you want Bitcoin? That's the way I answer that question. Bitcoin will be there. Blockchain technology will be there. Will it hold at current levels? Could, because the other issue that I have with it is I can't value it. I don't know what it's worth. I know they're limiting supply, but again, what is around it? What actually sort of backs it? And that's the question that I sort of have with regards to Bitcoin, and it's an interesting one. So look, traders beware. That's all I'd say to you. By all means, if you believe in it, go. That's up to you. I'm not a good person to ask that question because I don't fully understand it. But again, the reason I don't understand it is because I just can't work out what it's worth. Okay. Are there any other specific questions about tonight that you'd like to talk about? I'm just sort of having a look at sort of the questions here. A few of them are sort of more about sort of technology. So in today's age of technology and web, phone apps, etc., how do you follow news and stock speculation? Okay, just from my perspective, and I've got my phone in front of me, I do several things, and I'm happy to tell you how I do it. So before my feet hit the ground when I get out of bed, I'm pretty up to date with what goes on in the US. I have 3 major feeds in. One of them I get specifically from a subscription that I have, which is through FactSet. That's paid for. But if you don't want to pay for things like CNBC, things like Bloomberg, even things like Market Watch, they'll give you push notifications and you can scroll through them and get yourself at least a baseline to get up in the morning to go, okay, I know what's going on in the US, what happened last night, I therefore have got my leads. And if I'm an ASX trader, I can get up and have a fairly reasonable idea about what might happen. Now, I'll caveat to that. The ASX at the moment is slightly laxing with the leads coming out of the US, but it gives me a baseline. It also means that while I'm sort of getting ready, you start to get pull-in from these Asian markets, and you start getting those feed-throughs as well. They're really, really useful. I'm also not kidding when I say this. Get on Twitter. Follow people that you believe are really, really good. Follow outlets like Bloomberg, like CNBC, etc. Only follow about 50 things because otherwise it will cloud it up, and it will give you the best way of actually getting through that kind of information quickly, correctly, and smartly. It means that you can sort of get that sort of information much faster than if you're sort of going through a subscription base. And if you have it on the side of your of your rig set up, that you can actually sort of just have your Twitter page clicking through. It's like a Dow Jones Newswires of the old. It just gives you such better information. So what I would probably recommend, if you do want to get an idea for what's coming in on that question, you by all means have a look onto my Twitter page. I follow 350 people. Some of them you don't need to follow at all, but I would go and have a look at the news sites that I follow there. Just follow them, create a Twitter page that way, and it might give you the best opportunity. Yeah, good question. The next question here that come from is any time frame for the Aussie hitting 74 cents. Look, it might do it very fleetingly in the next sort of 3 or 4 weeks. It was thinking about going through 75 cents, and I think it broke through 75. It could quickly go down there. But on a medium sort of to a hold basis, and what I mean by that is actually getting down there and holding, I want to get through what happens in December. I want to get through what happens at the FOMC meeting, because as I showed you in that chart before, looking at what happened last year, although they're going to raise rates in December, the market may pick that up as a slow point, and it will therefore push the Aussie away from that position, and just put a bit of movement in that. So you can quickly see it jumping down like it did on the back of what was going on, but so fast jumped away. And that's really interesting in terms of what's going on there. So yeah, I would love to see it at 74 cents. I really would. And as I said, this may be an indication that the Fed can do it for you, but look at how fast the bid in the US dollar fell out, and you've got to have that in your backline. Is unfortunately, it's not this side of the equation. Oops. It's this side of the equation that can sort of cause that. So it may get there quite quickly, and it might happen in the next 3 weeks around the Fed. But as you can see from that chart from last year, that it got down there fast, went probably too far, down to 72 cents, and then snapped back real fast. Probably just go through one more question. I've got a question about the Nikkei. Nikkei is an interesting one. It's probably the strongest correlation to a currency, and what I mean by that is that if you look at the inverse of dollar yen and the Nikkei, their correlation is the last that I was looking at. I haven't looked at it for a while, and you need to put that out there. The correlation is about 73 to 74%. So it's really quite tight. So if you actually see dollar yen moving down, you should see the Nikkei going up, because again, they're a really good export market. I haven't been following the Japanese markets as close as I used to, and the reason for that is I just don't have the patience. No, patience isn't the right word. I don't have the time as much as I used to. And the reason I say that is that if you want to trade Japan, you have to live and breathe it. And I say that deliberately because dollar yen, I personally believe, is the hardest currency pair to get your head around. It's the hardest currency pair to really want to trade. There's some really quite interesting adages around how you say it. I'm not going to say it on here because some of them are actually quite horrible, but the baseline is there, that dollar yen is tough, which makes the Nikkei quite interesting as well. But the way I'd answer that question is that the correlation between dollar yen inverse and the Nikkei is relatively strong. It's broken down a couple of times, but if you probably have a look at them right now, that's probably the best way to answer it for you. I can see one more question. Do you believe the Eurozone economy is improving most out of all global markets? Oh, interesting question. It's coming from an incredibly low base in terms of where that's at. It's certainly improving, but as I said, at 1.4%, that's pretty anemic. If you drill into it, if you look at places like Germany, if you look at places like the Netherlands, if you look at places sort of on that sphere, sort of Austria as well to some extent, they're doing all right. French are a little bit sluggish. Then you get the sporadicness that is Italy, Spain, and Portugal, and they're interesting ones. And it's still fragile. The peripheral area is still fragile, and that needs to be part of it. So if you want to look at the developed world, and actually, if you do really want to have a look at that, let's sort of go back to the best way I can answer that for you, which is here. If you have a look at it, you know, it's not what you'd call brilliant. in terms of starting here. So Spain, I mean, it's jumping right up towards the end of this year, but it's supposed to fall away to 2.5% next year. Now, Spain's been coming off an incredibly low base. And if you have a look at the Euro area as a whole, it's supposed to drop back next year in terms of where it is. And that's, again, why the States is still the place. It's still the place that looks like growing at a reasonable, in the post-GFC world, rate. It's showing that wealth is moving. It's actually showing that inflation is growing, and it's why it remains the bright spot of the of the global economy, and why their market is still, without doubt, the one that everybody's been wanting to be involved with. Some people point out, look, the Nasdaq's doing what it is because everyone wants to be involved in tech stocks. That's fine, but what I would say is that tech stocks are the epitome of growth, and that gets back to sort of the principle that I had from it beforehand. So with that, I think I've run out of questions. Thank you so much to all of you that have put in questions. Thank you so much for spending an hour with me. I do apologise for speaking. I know I speak quick. I hope you got it. As I said at the start, I know Chris has been recording this for you, so you are more than welcome to go back over it. If you do have any more questions about the seminar itself after the fact, please don't hesitate to write into FP Markets. They'll filter through to me and I'll feed you back the answer. And if you do and have enjoyed that, please also send that through to them, because we are hoping to look at doing this on a more regular basis.
Okay, thank you, Evan. I'm sure I speak for everyone that attended the webinar tonight that they've got some really valuable insights into top-down trading, and particularly in the global macro environment. Like Evan said, if you guys do have any additional questions, feel free to send them through to sales@fpmarkets.com.au, and I'll be able to relay those onto Evan and hopefully clear up some of those queries. And as I mentioned at the start of the webinar, we are running a bonus for everybody that did attend the webinar. Now that's for our MT4 customers. With a new account, you'll receive a 20% trading bonus up to 2,000 Australian dollars relative to your initial deposit. For new IRIS CFD accounts, we'll be offering no minimum for the first 3 months. So a trade with a market value of $1,000 would only cost you $1 in commission. Now the link to apply and the terms and conditions can be found in the chat, but you'll also receive those in a follow-up email for your attendance. And now, just to let you know, we're also offering Bitcoin. And like I said, if you've got any more questions about the webinar or FP Markets, feel free to shoot them through to sales@fpmarkets.com.au. I'd like to thank you all for attending tonight, and have a good rest of your week.